Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Steve Brice and I'm Standard Chartered Bank's Global Chief Investment Officer. Welcome to a special series of the Through the Noise podcast, where we explore our outlook for financial markets in 2025. And we'll be talking to several different members from the CIO office. Today, to set the tone, I want to welcome Manpreet Gill, who's our Chief Investment Officer for Africa, the Middle East and Europe, based in Dubai, to discuss our views on what are likely to be the big drivers for markets in 2025, what we see as the most attractive investment strategy, and what could potentially go wrong. So, Manpreet, let's get started. So, I guess a year ago, we were looking at 2024 as a year with a huge amount of elections. I think that was a record, actually, in any calendar year. Now that we're almost through the end of 2024, how do you see the outcome of the elections impacting financial markets in 2025?
Hi, Steve. Indeed, 2025 might be the year where the policy outcomes of these elections start to bite. For financial markets, U.S. election results are, of course, one cornerstone. As Trump's administration takes charge, markets are likely to be very focused on how his business-friendly approach balances with the risks of trade tariffs, potential immigration changes, and fiscal deficit worries. Beyond the elections, though, central bank policy could eventually matter more. In the US, we expect the Fed to continue cutting rates to 3.75% by 2025 as it seeks to balance supporting growth with the inflationary risks that usually accompany more robust growth. In our view, that should help make a soft landing, or indeed a no landing, more likely for the US economy. Outside the US, dispersion in policy is likely to rise. So central bank policy in Europe and China is expected to remain a debate only over how much easing is needed to support weak growth. And meanwhile, the Bank of Japan, of course, likely to stand out as the only major central bank raising rates gradually. And many EM central banks may not be needing to cut rates as quickly as the Fed. So overall, on balance, we're of the view that this type of policy backdrop should be a positive one for risky assets in 2025.
Okay, so given that backdrop, how should investors be positioning their portfolios in the next year?
Well, like I said, we believe this macro backdrop should favor risky assets, so we start by being overweight on global equities. Positive growth, support from both monetary and fiscal policy, both should bode well for corporate earnings. I think one key question we receive often is whether this type of outlook is fully priced. Elevated valuations are likely to limit multiple expansion, and investor positioning could trigger some short-term volatility. But in our view, earnings growth can still drive total returns that outperform cash and bonds. This subjective view, of course, supported by a quantitative stock bond model that's also overweight equities despite some of the weaker data in recent months. We also hold an overweight view on gold. Ongoing central bank demand is likely to remain a key driver of prices. Now, this is not completely price insensitive. Indeed, we've seen major EM central bank demand ebb and flow with the price, which likely explains the recent slowing of central bank demand. In the bigger picture, though, gold as a share of global EM FX reserves remain small and geopolitical risks remain high. We believe this combination means that central bank demand will continue to be the main support for gold prices over the next 6 to 12 months, with safe haven demand, inflation worries, or falling bond yields only being a bonus. So while those are the two overweights, on the other side, we are underweight cash. A long history shows us that it's rare for cash to outperform any other asset class over 12-month or longer periods. And ongoing Fed rate cuts mean US dollar cash yields will likely continue to fall through 2025. In our view, that makes it more attractive to lock in current yields for longer via bonds. That is why we see bonds and alternative strategies as core holdings. Bonds continue to offer an attractive yield, especially relative to cash. However, we believe a stronger growth outlook and hence incrementally higher inflation worries mean any fall in yields is likely to be relatively shallow. This means we still expect bonds to deliver cash-beating returns, but it's really the yield that's likely the main driver of total returns. Finally, we continue to see alternative strategies as a key component of well-diversified portfolios, given their relatively lower correlation to other major bond asset classes.
Okay, so let's get a little bit more granular. Obviously, there's been a lot of talk about US exceptionalism. One way to look at that is the US economy and markets continuing to outperform the rest of the world. In your view, can this continue for equities?
Uh, well, in our view, yes, which is why within equities we are overweight US equities relative to other major regions. Our macro scenarios, Fed cuts, and President elect Trump's stated policies do argue for continued outperformance of US growth relative to other major regions. And this, we believe, will translate into superior earnings growth for the US markets. Now, technology and AI linked sectors are likely to remain a key theme, but our macro scenario does argue for a broadening out of equity gains to other sectors as well. So, on balance, we believe this will result in US equities outperforming other major regions despite the headwind of today's starting valuations. Now, on the other side, we balance that with an underweight in euro area equities. The region remains at the opposite end of the spectrum as weak domestic growth and possible US trade tariffs hold back earnings growth despite more attractive valuations. Japanese equities, of course, we see as a core holding as continued shareholder friendly reforms balance against yen driven volatility. In Asia ex Japan, which we see broadly as a core holding, individual markets offer a more mixed set of outlooks. Our overweight, of course, focused on Indian equities, where growth may have softened a little bit recently, but we like the greater growth visibility, which we expect to translate into continued earnings growth. In China, we hold a neutral view on Chinese equities with a relative preference for onshore markets. In our view, they're likely to be sensitive to the nature of both domestic stimulus as well as US trade policy. Further policy support in China is likely to continue being added, both on the monetary and fiscal sides, but policies seeking to directly support domestic consumption demand, which is what markets have been seeking, does appear unlikely for now, absent a big external trigger.
Okay, so let's move on to bond markets. You sort of alluded to this a little bit in terms of yields coming down, but not dramatically. Do you see bonds still as an attractive source of income, and has the dollar moved into a higher range?
Uh, yes, that's right. I think within bonds, we do see yields as important, but that's part of what drives our overweight on developed market high yield bonds. Now, this overweight might seem odd at a time when credit spreads are as tight as they are today, but history does illustrate these type of valuations can remain high for an extended period of time as long as credit quality holds up, as we expected to do so in a soft or no landing environment for the US economy. This means the higher yield on on DM high yield bonds is likely to be sufficient to outperform global bonds if bond prices themselves rise only modestly. At the other extreme, we're underweight EM local currency bonds, given we see less pressure in many EMs to cut rates and higher currency risks given the vulnerability from US tariff policy. Value outside of high yield does remain harder to find, which is why we hold a core holding view across investment grade bonds, both government and corporate in developed markets, as well as dollar EM bonds, including across Asia. A common thread across all these sub asset classes is that they should remain well supported by credit quality in a soft or no landing scenario, but elevated valuations do reduce the risk reward balance. Now, for most US dollar denominated bonds, we do expect US government bond yields to set the tone. We expect the yield on the benchmark 10-year bond to gradually trend lower towards 4 to 4.25% over 6 to 12 months, with the downside magnitude likely being limited by stronger growth and inflation pressures. And this links to our view on the dollar, which we expect may have similarly moved into a higher range because expectations of tariffs and US asset class performance have likely been behind the US dollar index, pushing up against the top of its approximately 2 year range high. But capped US bond yields is why we expect the dollar index to ultimately soften moderately over the next 6 to 12 months. There is some speculation that a weak dollar policy could be achieved via a Plaza Accord style agreement by the new US administration. But for now, we see this more as a risk scenario rather than something as part of our base view on the world.
Okay, that's a good segue into my next question, actually. So obviously, we know that these views are subject to change depending on what happens in the environment. So maybe give a sense of what could cause you to change your mind in 2025.
Well, there are always a few candidates, and in markets, it's funny that there's never a shortage of things to worry about. But I think it's important to note that we're starting 2025 on the cusp of several pivotal points that do risk changing the narrative. So, firstly, in the US, President Trump is set to take office in January, after which we're likely to witness much greater clarity on the precise details of his proposed policy agenda. So that's one. A second is in China. Policymakers continue to offer a range of policy support measures, and that, of course, holds the potential to shift the growth outlook. And third, stronger growth ultimately raises the question of whether inflation risk could rise and whether that could limit headroom for the Fed to keep cutting rates. So they're all risks, but these are three we'd watch in particular as risks to the view we've outlined, in this conversation.
Thanks, Manpreet. That seems like a good time to sort of wrap up today. Thank you, listeners, for joining us for this conversation. We hope you enjoyed the podcast, and will join us for the next one in this series, where I will speak to Rajat Bhattacharya for a more detailed conversation on the macroeconomic outlook for next year, as well as the currency market outlook. So thank you so much again for joining us, and wishing you a very pleasant day.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.